Singapore this morning with Mr. Leo Tameeris, CEO of NRG Global. Good morning, Leo. Welcome back to the table. Has China finally disappointed?
I don't think so. I think the only figure that was disappointing was the factory throughput in February, which was a 9-month low. But then February was also the shortest month in 9 months, and then a chunk out of that was taken out of that by Chinese New Year. So it's not surprising that factory throughput was low. All the other indicators still point to growth, to strong growth. PMI indexes, manufacturing is still above 50. The domestic demand PMI is above 50. Only the export PMI is below 50. Another indicator is container throughput. Container throughut so far this year in the main Chinese ports has been 10% up from versus last year. So it still looks like it's going to be a very, very strongly growing economy, and no disappointment at all.
Peter McGuire, CEO of XM Australia, sitting in Sydney. We saw a departure over the last few days, Peter, between equity markets and oil, which were kind of moving in tandem, seem to have divorced over the last few trading sessions, with oil prices clearly softening, whereas equities keep hitting the records. Peter, you're on mute, sorry.
Pardon me, Sean. Good morning, everyone, and team. Yes, I would have thought that, Sean. And, when I'm looking at those numbers coming out as far as Dow, S&P and NASDAQ bid up 3% overnight, and Dow and S&P between nearly 2% and 2.4% respectively. So very, very strong. And I was expecting that wash, Sean, to continue across Asia trade today. And it certainly hasn't, where we've got China down the best part of 1.5%. So maybe the crude market coming back and that China softness are going hand in hand. Brent still 63, NYMEX 60, so they're still above that magic number. Probably a little bit exhausted, profit taking. US dollar, Sean, since Thursday, and I look at that US dollar index as a matter of 25 times a day. 89.6, 89.7 Thursday evening here, now 91.2. So that really is a big push to the upside.
Why do you think is driving that? Inevitably, typically that's a flight to safety indicator, is it?
Yeah, I think it was possibly overdone as far as a sell. So the shorts getting squeezed first. Secondly, those bond yields, Sean, that really took everyone very much by surprise, in that big washout that we experienced naturally on Friday with equities. So it's a time of, I think, consolidation, push back above, and maybe that US dollar just having a little bit of a field day as far as big volatility swings. Gold's been also heavily sold off. And really, I don't think the crude markets have moved that greatly over that matter of days.
Robin Mills, CEO of Qamar Energy. Good morning, Robin. There seems to be some nervousness growing in the market that OPEC may overshoot on Thursday and add a bit more back to the supply side than is warranted. Your own thoughts on outlook for that?
Yes, morning, Sean. Yes, look, I think the rally well above $60 was a little bit overdone. I think several people had commented on that. A little bit triumph hope over expectation, and getting ahead of ourselves on the demand recovery, which is coming, but still. We need to be cautious on that. So I think it's not surprising there's been a bit of a pullback. And I think OPEC, the talk of OPEC increasing production significantly, and that has obviously fed into the prices pulling back a little bit. But I think it would make sense because, when prices have shot above 60 so quickly, that is a pretty clear signal to put some extra oil back on the market. That said, I do note Prince Abdulaziz's comment that OPEC should be very cautious, so that might temper that expectations. And I think that there's some thought of bringing back the 500,000 barrels a day. But I'm curious to see. Obviously, a very key thing will be the Saudi voluntary cut of 1 million. Do they say anything about that, or do they perhaps quietly start trimming back on that extra voluntary cut?
Leo, the markets seem to have forgotten about, or at least parked on the sidelines, that indeed there is this 8 million barrels of idle supply sitting. Any other time in history, if you had 8 million barrels of idle supply available to the market, the prices might not be rising, but they may be falling. Is the OPEC meeting a reminder to the market that indeed there is a lot of extra supply available?
I think that's correct. There's excess supply. There's extra refining capacity available to be cranked on if needed. So if prices go back to the levels where China like to buy, like in November, December, around in the 40s, then the market will come back. The demand will come back very quickly.
And from that point of view, where do you think Asia is at? I mean, from the weakening dollar, the strengthening dollar, does that weaken Asia's sort of appetite for crude at these levels? We're seeing, let's say, for example, in India, considering cutting taxes on petrol and diesel.
Yes, I think that's more driven by domestic pricing, where all the commodities are up. I mean, don't forget, the governments in India have fallen over the price of onions in the past, so they're very sensitive to pricing to the consumer in India. Otherwise, I don't see the currency has so much of an influence in demand here in Asia. Some of the currencies are more or less pegged to the dollar, so it doesn't have much influence. China manages the currency to an extent to where they want to see it. I think the demand is mainly driven again to a large extent by a continuous strong growth in China.
Peter, should we take some longer-term confidence with the copper price continuing to rocket, punch through $9,000 last week, highest since 2011? What do we interpret from that?
Well, Sean, it's been a great time to be long copper and a lot of those base metals, iron ore as well. So yes, I think it's just coming back to, and you've got to say that it's been worked off the back of crude. That's had such an enormous rally since October. It's all been swept up. Industrial demand improving, general consensus as far as economies coming back to speed, and 21 may mirror image to some ways, or the second half of it, what 19 was, coronavirus, vaccines. And I feel as though that things were certainly very oversold, and that rebound is just enjoyment for traders, the same as what we experienced in crude. If you didn't make $1 out of crude from the end of October till the start of March, then you might as well give the game away. So that's the same as far as copper, still off that $12,000 highs that we've had as far as longer back. And it's still cheap in today's terms, Sean. It's, $9,000 a metric ton is still ridiculously cheap. So is crude oil if you put your mind back.
In what context?
Well, if you put your mind back to July 08, where we had 147 for crude, 13 weeks later, we went to $33.
Right. Anything can happen, clearly. Robin, with OPEC are looking at the different tea leaves ahead of the meeting on Thursday. The fundamentals are inventories where they want them to be in order to support an increase in supply in the second quarter. Are shale oil production sufficiently curtailed for them to add barrels? Where do you think the fundamentals stand right now as OPEC put together a decision for Q2?
Yeah, it's a tricky one, Sean. I think, look, we've started seeing some signs that these high prices are having an impact on the recovery, and they've gone a little bit too high. You mentioned the example of India, of course, and the Indian Petroleum Minister, as Indian Petroleum Ministers are expected to do, complaining about prices being too high. But that is a genuine concern. Chinese buying. But
it's not only India, Brazil. We're even seeing in the UK. There's indications that taxes and petrol prices rising.
Yeah, sure, absolutely. And Chinese buyers perhaps putting back a bit on the speculative buying as well, with prices going up. So that's a concern. And I think the other thing to watch is obviously the US and how much these higher prices start incentivizing extra drilling, because however much US suppliers say they've learned the benefits of capital discipline, that 3 months of high prices will, and that'll all evaporate. So, the OPEC definitely doesn't want to see US production coming back strongly yet again. That's a concern. On the other hand, the physical oil market, there's certainly some signs of weakness in that. West African crudes, particularly struggling to get sold. So that's it's a little bit of a difficult balance. But I do feel that the price rally has been stronger than was really warranted by the fundamentals. That OPEC should look to put some more crude back on the market and just cool off the rally, because, as you say, there's this enormous overhang of spare capacity, and that means it's not really a tight market. Yes, OPEC can keep it tight for a while artificially, but in the end, their objective has to be to try to get back to what they were producing in 2019.
Well, in that sort of virtual tightness, if you want, there is Iran. Where does Iran stand? Is that bullish or bearish, really, for the outlook? And how should OPEC Plus look at that? The signals between the rapprochement, one day it looks like it's sort of getting there, the next day it looks like they're very far apart. How do you read the tea leaves on that at the moment, Robin?
This is the diplomatic dance that we saw, back when the JCPOA was originally signed. So, both sides are trying to signal their intentions and stake out their positions. However, I think it's shown that it's going to be a bit more difficult than people expected, and Biden has not been Obama 2.0. He hasn't just jumped straight back into the JCPOA, even though obviously he was VP during that time. He's been more cautious, and his team have also tried to signal that they're not going to be rolled over by the Iranians, and they'll take military action against them where they feel it's warranted. And he's got his own domestic flank to consider, that he doesn't want any accusations of seeming soft on Iran. So I think it'll take longer, and I think we expected this for a while, that we would not see a significant deal done and having a real impact on the market until later this year. Iranian exports have gained a bit, so there is more Iranian crude back on the market, but in terms of a real relaxation, not until quite a bit later in this year, I think. And there's some Iranian issues coming up. The new year, we're almost at the Iranian New Year, and then we'll be getting well into their presidential election season. So there's quite a few things that will act against a swift deal with Iran.
Leo, on the issue of tightness, or the perceived tightness, there's was a narrative growing in the market in recent weeks, alongside the Saudi decision to unilaterally cut 1 million barrels a day, that there was this perceived tightness despite the 8 million of idle supply that we were talking about. What's the view, do you think, from Asia? Is this a tight market, or are we misreading it? I mean, Chinese inventories, they built them up massively high last year, I think to near record levels. Is there tightness in Asian physical crude oil supply markets?
I don't think there's any feel of tightness in these markets. As you mentioned, the Chinese inventories are at record high levels. Eased down a little bit, but they're well over 100 days of imports. Well, the goal is 90 days. Strategic stock seems to be filled out. The private terminals still have space, but it's full. And so and there's still plenty of oil being offered on the market. China is going into some maintenance in March and April, so but those barrels have not been bought in January, February. So that means that the demand in January, February was lower to cover for this maintenance. In March and April, they should be coming back into the market to buy up those barrels for after the maintenance when they fully started the refineries again. But there's no sense of tightness in these markets, in spite of a backwardated market, which seems to indicate otherwise. But there's still plenty of oil to be bought in.
Peter, we saw again yesterday the S&P have its strongest day for over 6 months, with the bond markets appearing to calm down a little bit. Are we through this bond wobble, or is there more nervousness to be had there, do you think?
I think there's more nervousness, Sean. I think the uncertainty, the inflation story, all of those inputs, the volatility that we've seen as far as US dollar, sell-off for most of the other currencies, And whilst we did have that very strong move, and it was no doubt, very, very over the top, 3% up, got to remember that we had a 4% wipeout on Friday for the Nikkei, and we had a very solid sell-off as far as US equities on that Friday. So they're all, I think it represents one thing and one thing only: volatility and that nervousness that we can see those big whipsaws. Put your mind back. You get 3 and 4% swings in a day. For short-term traders, it can be a delight, but longer-term holders, it really puts a sense of nervousness out there.
What's your thoughts on the 1.9 trillion stimulus? I mean, last week it was supported by the House of Representatives, now in the Senate. Is that baked into the market at this point? I mean, it was finally delivered and the market sells off. I'm trying to understand, is the 1.9 trillion stimulus something in the rearview mirror rather than ahead of us from a market point of view?
I think it's for the recipients, it's ahead of them, and for the government and for the government and for the market, Sean, I think it's already been baked in. It's behind them. So that feel-good, good news story is already there. It's just contributing, and we can't get away from the numbers that we're experiencing as far as, those record Dow numbers and S&P, and NASDAQ, of course. So the earnings are there. The storyline is very, very much the same as far as, is this the last time you'll see stimulus to the general public of America? Or are we going to have another round, say, May, June? And that's out there somewhere, bubbling away to, and until we probably get over the next 8 weeks to get a clear indication of what the status quo is.
Robin, will this be the first meeting for OPEC Plus in over a year, or a year perhaps, in which they don't have to see COVID and pandemic and lockdowns into their strategy? Can they now park that? Obviously, there's still issues out there of significance, but ultimately, from a planning point of view, can OPEC Plus park COVID?
Well, look, we're in we ought to be in the recovery phase, right? But it still dominates the market and everything that we have a view on. Now, perhaps not in China and so on so much, but absolutely still very much in Europe and the US. But as we hope we're in the recovery phase, right? The vaccines are highly effective. We're getting better news. The Johnson & Johnson single-dose vaccine is out, being delivered in the US. That eases logistics. We're seeing very sharp falls in case counts in UK, US, and elsewhere. So it's all very promising. Still some concerns out there, and particularly on these variants. How effective are the vaccines against the new, more contagious variants? And there will continue to be local lockdowns, local surges and outbreaks that have to be dealt with. But I think broadly we're in the recovery phase. So OPEC can't ignore it by any means. But OPEC can at least shift from the mentality of how do we deal with this massive drop in demand and mobility to how do we cope with and how do we adjust to the gradual rise again in demand as economies reopen and get back to somewhat normal. But really, the key thing we need to watch here, obviously, is air travel, jet fuel, because that is the part of the oil complex that has been by far the hardest hit. How soon will we see mass air travel resuming, and will we start to get some clues about whether the air travel industry has been permanently affected by this or whether it'll quickly bounce back? I think you could easily imagine, by this summer, everybody wants a holiday, everybody flies off somewhere, and there may be a surge in demand. But will that be sustained, or will the kind of new ways of working and less business travel and so on be a permanent feature, or at least a feature for a few years?
I suppose a lot of those questions, you could, in the post-COVID world, what is legacy, what sticks with us versus what it goes back to the way it was. It's very difficult for OPEC to plan for that right now. But let's get the survey question before we put our panelists on the spot a little bit as for what they actually think will happen this week with OPEC Plus, what decisions they will make for the second quarter. But it's this question of the stimulus package. We had Peter sort of indicate there from his perspective, this is already baked in the cake. What is your thoughts? Has the oil market already baked in the US stimulus package due to pass later this month, but it's already baked into the market? So everybody give us your thoughts on that, and we will go around the tables for some views. Leo, your thoughts on where OPEC should go, will go with their decision this week?
Well, I think they should not increase or put extra barrels on the market, but I think that will still happen. I think Saudi will probably be disciplined. I mean, the main equation for Saudi is oil price times reserves, because that's the value of Aramco on the exchange. But Russia may start to balk at not putting more barrels on the market. And then we could still see easing of the out of Iran and other areas to come. So they should not increase, because I think the market that will be bearish on the market.
But should they not be listening, Leo, to their customers in your neighborhood that are sort of starting to feel the pain a little bit of the price recovery at this fragile time?
No, but when you look at what they're refining at the moment is what they bought 2 months ago, right? So, and that's still at better levels. And what's in storage is what they bought in the middle of last year at even lower levels. So they still have a buffer to go and ride it out a bit. So I don't think there's too much pain to be felt yet. Even refining margins are lower, even also in China, but still not negative.
And there's also the tool within the consumer's toolbox, I suppose, that, like we're seeing in India, they can reduce taxes at the pump if they want to ease the price.
Correct.
Peter, your thoughts? Obviously, we're not flying off to Vienna. That would be a nice extra bit of fossil fuel consumed in some regards. But nonetheless, where do you think OPEC will go, should go?
Sean, I think they've got to look at, they must be happy as far as pricing. There's no doubting that as each month has rolled on, prices have moved up and continued to move up. So there's a level of comfort. It's a difficult one to really forecast, but I would say that they're far more relaxed and far more, I think they'd be patient. They'd be patient in the sense they realise the hurt going out there, and that was highlighted, as you mentioned, as far as India and developing countries. They know that probably the price is too high at the moment, but they're banking the dollars. So I think that they'll take all of those points on board and just sit down and just reflect on the current situation.
I mean, as you said, they do have the opportunity in which to, they are meeting monthly, so there's no long-term decision that has to be made. Exactly. It gives them some flexibility. Particularly, specifically, Peter, your thoughts on the Saudi unilateral cut. Do you have any sense of where do you think that will go?
I feel as though that they're the market maker and they're the largest the elephant in the room, Sean. So they've got far more flexibility, and I think they take the charge. So possibly that may be continued over the next couple of months, but at the present, I would say that they're just very much playing to their rule book, and I think that they're conscious as far as that US dollar. So they're happy again also with pricing at that $60 level. I don't think too many will want to upset the apple cart too much.
Let's go with the survey result and see where that is, the view in the room on the stimulus package. An overwhelming majority, more or less, that is already baked in. Robin, your thoughts on where they should go? I know you were, over the time, have been advocating for OPEC to reclaim the opportunity to have their market share back sooner rather than later. Is that something that figures in the considerations, you think, this week, regardless of where the price might go?
Well, what will they do and what should they do? Maybe slightly different questions. But
yes,
look, I think there's quite a bit of pressure to bring back the 500,000, as they were planning to do on a monthly basis, right? I think the monthly meetings are a good idea in this phase, so that enables them to adapt to the changing circumstances. And there's been quite a bit of pressure, I think. Obviously the UAE a little while back was pressing for higher output. Iraq has been testing the upper limits. Iraqi production and exports were up last month. So I think that there's been pressure to bring back the 500,000 as planned and say, well, look, the price is well above 60. So it's time to ease off on that. The Saudis, I think, will be quieter about their voluntary cuts. And I think for them to bring back the full million, in fact, they cut about 850. So for them to bring back the full 850 would be too much all in one go, along with the 500,000 from the others. So I think more likely we'd see the 500,000 come back, and the Saudis, whether openly or a bit more quietly, easing back on their cut, but still having an additional voluntary cut.
And was that your should or would or will on that?
I think that's my guess on the will.
Right.
On the should, yeah, as you say, Sean, I've been kind of suggesting they should be a bit more aggressive in bringing back production, even at the cost of prices going lower for a while. However, I recognise that the market signals are still a bit contradictory. The price is quite strong, but the signs of weakness in the physical market. So I can understand that they wouldn't want to dump a full 1.5 million on the market all in 1 month.
Well, it certainly will be also the added sort of detail that will they be meeting with prices in a falling momentum or in a rising momentum? It would appear that prices are in a falling momentum at least today, Tuesday morning, out of Asia, and Friday, Monday, Tuesday. It feels that, and that sentiment might also give pause for caution, because there was a sense that, not long ago we were nearly knocking on the door of $70 a barrel on Brent, and that might have created a very different sentiment in the market or in OPEC's decision making. But with a declining market, WTI possibly dropping below 60, it may be encouraging the sentiment of caution, or extreme caution, I think was the words that Prince Abdulaziz used. But that's a wrap for today. Leo, thank you for joining us from Singapore. Peter from Australia. Robin, obviously from Dubai. Thank you all. We will have our halftime talk this week with India, with the senior energy advisor, the BJP party, giving us that strong sort of view from the consumer as to what OPEC Plus should do on Thursday. And we know what the answer is already, but let's get it on the record. Thanks very much, everybody. Have a good day.
Thank you, Sean.
Thank you, Sean. Thank you, team.